Oh, Jerry, the tragedy. Cookies cannot handle that. So joining me now is Forbes Media Chairman Steve Forbes. How real is this break, Steve, between what the market is doing over the past 2 days and the pain being felt on Main Street?
Well, the pain is very real, and the fact that prices in some areas may not be rising as fast as they were still means prices are going up. Hello. And in terms of the market reaction, the market is hoping that because the inflation rate seems to be coming down somewhat, that the Federal Reserve won't be increasing interest rates at the pace they were. And so they're anticipating a little less severe Federal Reserve. But I think the Fed has done enormous damage already with the interest rates they've done to the economy, and they're going to be reflected early next year. And so Biden has taken too early of a victory lap. He's going to have to be doing a lot of explaining early next year.
So the Wall Street Journal editorial board calling it a tentative inflation break, but lots of work still need to be done. Where are we, as you talk about this inflation with the Federal Reserve, where are we in this fight for inflation? Has it peaked?
No, well, there are two kinds of inflation. One is from things like the lockdown and the supply chain problems, which are still there. China's just beginning to acknowledge maybe they won't be so crazy on COVID lockdowns anymore, which has hurt supply chains. But in terms of monetary inflation, the Fed has already done enough. It takes 12 to 18 months when they start to tighten up for it to really smack the economy. So they've already, you can see it in the money supply number. You saw it on gold. And so the Federal Reserve has already done the damage. The question is, it's going to start to show up next year, where even the economic theologians are going to have to acknowledge we're in a recession, sadly.
So you think the Federal Reserve has already gone too far and needs to pause in this next meeting? Because there is an expectation that they're going to go 50, well, it's split between 50 and 75 basis points in December.
Yes, that's part of the problem of the Federal Reserve. They don't realize they're doing a big freighter or a big ship. And when they change course, it takes time to change course. The economy is changing course. And the Federal Reserve, there is beginning to be a shortage of liquidity. So the market's anticipating that the Federal Reserve will back off. I don't think the Federal Reserve will back off because the Fed doesn't know how to measure on a timely basis, real-time basis, whether they've got the price, the situation of the dollar in hand. The dollar's become very scarce. Now, It took a bit of a fall in exchange rates, but it's still very high.
Yeah, and with that lag. So mortgage rates, I want to talk about housing, jumped back above 7% after dropping last week. Are we headed back to those days of 10% or more because the Fed just won't stop?
No, I don't think it'll get that bad.
Okay.
Because one of the things, the Fed has this crazy belief that the way you conquer inflation is by trashing the economy, making people poorer. So that eventually brings prices down, just as it did in the past when they've done that. The key thing is the way you really conquer inflation is have a stable measure of value for the dollar. And the Federal Reserve still believes that if we have a lot of prosperity, that means inflation. And if you trash the economy, make people poorer, that'll bring prices down. Yes, it will temporarily, but if they go back to what they've been doing before and they're not preserving the integrity of the dollar, by golly, they're going to have the same problem again.
Right. Steve Forbes, thank you very much. I really appreciate it. Insightful things.
Thank you.
And the Fed is not going to stop, so this conversation is not going to go away. Thank you very much for your time.